If you're a foreign entrepreneur thinking about setting up a company overseas, chances are you've heard that Hong Kong has one of the most business-friendly tax systems in Asia. At first glance, it looks simple, a two-tier corporate tax structure and in some cases, the chance to pay zero tax on foreign-sourced income. But what does that actually mean for you? Hi, I'm Jess from Statrys. In this video, I'll break down Hong Kong's corporate tax rates for 2025, walk you through how the two-tier system works, and show you how your company could qualify for an offshore tax exemption. Let's get started. First, let's look at how Hong Kong's corporate tax system actually works for incorporated companies with real numbers. Quick note before we dive in, we'll focus only on private limited companies. That's the standard corporate vehicle in Hong Kong. Yes, there are other forms like sole proprietorship and partnerships, but they only make up a tiny fraction of all registered companies. Here's how it all works. In Hong Kong, a private limited company pays corporate tax at two different rates, depending on how much profit it earns. The first 2 million Hong Kong dollars in profit is taxed at just 8.25%. Anything above that gets taxed at 16.5%. Let's look at a concrete example. Say your company made 3 million Hong Kong dollars in profits last year. Here's how the calculation looks like. The first 2 million is taxed at 8.25%, which is 165,000 Hong Kong dollars. Then the next 1 million is taxed at 16.5%, which is also 165,000 dollars. So the total amounts to 330,000 Hong Kong dollars. That works out to a blended tax rate of around 11%. Now, how does that compare internationally? In many Western countries, corporate tax rates are much higher, often ranging from 20 to over 30%. For instance, the UK's headline rate is about 25%, and Germany's can reach up to around 30%. This is why Hong Kong's two-tier corporate tax system makes it such an attractive place to incorporate a company for foreign entrepreneurs. Now, let's talk about Hong Kong's territorial tax system. In simple terms, Hong Kong only taxes profits from business activities that actually happen inside Hong Kong. If your company generates profits entirely outside Hong Kong, those profits may qualify for 0% corporate tax. But here's something to keep in mind. To qualify, you'll need to submit what's called an offshore claim with the Inland Revenue Department, or the IRD, when you file your annual tax returns. And the IRD doesn't just take your word for it. They review every claim carefully and may require supporting documents. In other words, be ready for possible audits or inquiries from the IRD. Now here's the key point. The IRD looks at where your profits are actually generated. If your business activities such as negotiating deals, signing contracts, or delivering services take place outside of Hong Kong, your profits could be exempt from tax. But if those activities happen in Hong Kong, the IRD may consider your profits Hong Kong sourced and fully taxable. Put simply, to benefit from the territorial tax system, you need to avoid any direct connection between your business activities and Hong Kong. Let's cover some best practices and things you should avoid. Here are some things you should do. Keep your profit-generating activities outside of Hong Kong. Make sure you sign your contracts, deliver your services, and store and ship your goods from overseas. Keep solid documentation, contracts, invoices, travel records to prove where the value is created, because that's exactly what the IRD will check. Now, here are some things you shouldn't do. Don't sign important contracts while physically in Hong Kong. Don't deliver services or negotiate major deals within the city. Don't rely on vague explanations. The IRD wants evidence, and they can audit you if things don't add up. Let's look at two examples to help you understand. Example number 1. Your Hong Kong company sells products to customers in Australia. The goods are stored in China, shipped from China, and the contracts are signed in Australia. In this case, your income may qualify for offshore exemption. Example number 2. The same business, but this time the goods are shipped from a warehouse in Hong Kong and the contracts are signed in your Hong Kong office. Here, the IRD would classify the profits as Hong Kong sourced, meaning you pay the full corporate tax. And here's an important warning. Even if everything looks offshore on paper, the IRD can still challenge your claim. If they find that real decision-making or negotiations took place in Hong Kong, they can reject your exemption. That's why detailed evidence, contracts, invoices, travel records, and operational documents is absolutely critical. Now, let's look at some of Hong Kong's other tax advantages. First, Hong Kong doesn't tax several types of income that are heavily taxed everywhere else. For example, when your company pays dividends, there's no withholding tax. That means you, as the shareholder, receive the full amount, no deductions. There's also no capital gain tax. So if you sell your company's shares at a profit, that gain isn't taxed in Hong Kong. If you earn interest income from bank deposits, that's generally tax-free as well. All of this adds up to one simple advantage. You get to keep more of the profits your company generates. Hong Kong also offers specific incentives to help reduce your tax burden. Let's focus on two that are relevant to most businesses. First up, the Foreign Sourced Income Exemption, or FSIE. Basically, if your company earns money overseas from dividends, interest, royalty, or even capital gain, those profits can be exempt from tax in Hong Kong. The catch? You need to show genuine business substance in Hong Kong. That means real offices, real employees, and real decision-making taking place on the ground. Second, there's a special incentive for intellectual property. If you develop or manage IP in Hong Kong, the profits from that IP could be taxed at just 5%, much lower than the standard 8.25% or 16.5%. Here's a quick example. Imagine you're a tech entrepreneur who sets up a company in Hong Kong and builds a mobile app with your local development team. When your company licenses that app worldwide, the royalty income could qualify for the 5% IP tax rate instead of the higher standard tax rates. Here's the bottom line. Hong Kong's corporate tax rates are highly competitive, and if your company qualifies for the offshore tax exemption, that's even better. But taxes and incentives are only part of the story. Before you make your decision, you also need to consider other factors, like how easy it is to open and operate a business account, plus ongoing compliance requirements. At Statrys, we help foreign entrepreneurs navigate this process with our full suite of services, from setting up Hong Kong companies to opening business accounts and maintaining ongoing compliance. Our fully online process is supported by dedicated account managers who offer support every step of the way. If you're ready to incorporate your Hong Kong company, visit statrys.com and click Get Started. Have questions? Reach out via live chat, WhatsApp, or email us at support@statrys.com. You'll find the links in the description below to the videos covering Hong Kong company setup and opening business accounts in more details. Thanks for watching.